everyone. Well, welcome back to our channel. In this video, I'm going to be taking you through a sample of a real franchisee P&L, of course, anonymous, but just be aware this is a lawn care franchise. Now, a major key to success in owning a franchise and being successful with it is understanding your P&L or profit and loss statement. This statement tells you how much in terms of sales are coming in over a period of time, and what expenses are being paid for, or rather, what is the money coming in and what is the money going out of your franchise. Difference between the two, the money in and the money out, or the difference between your sales and your expenses, is either going to be a net income if it's a positive amount, or a net loss if it's a negative amount. Beyond understanding this simple structure, I also want to give you a couple of tools that you can use to analyze your own P&L to tell if you are in a good spot, you're trending in the right direction, or potentially not. So let's get into it. So what you see here is, again, this is a real P&L. It's anonymized, and as you can see here, there's a lot of lines. I mentioned sales and expenses. So there can be detail that goes into what your sales are, different service lines or product lines. You also have your different expenses. Now there's two real types of expense. There's cost of goods sold and there's operating expenses. Cost of goods sold are expenses that go directly into delivering whatever the product or service is that you're selling. So for example, let's say you own a coffee shop. The cups, the coffee itself, the water, the employees that make the coffee and deliver it to your customers, all of those are direct expenses directly related to delivering what your product is. Lawn care, that's materials for landscaping, laborers who are doing the lawn care, the actual work. And so the difference between your sales and your cost of goods sold is called gross profit, which is an incredibly important number, which I'll get into in just a moment. All of your other expenses, called operating expenses, are all the other expenses that go into operating a business. So there might be rent, utilities, employees, but not the ones that are delivering the goods or services, like administrative, management, are all examples of operating expenses. So you take all your different operating expenses, those indirect costs in running your business, and the difference there is either going to be, again, a positive or a negative. In this case, it's a negative 166K. So that actually be a loss. So they should actually say net loss, but it is implied by the negative amount. So that's an example of a P&L. What can we do with this information? Just a little bit of a simple analysis that I want to show you here. So what I did here is I pulled those key numbers that we went over: sales, cost of goods sold, gross profit, expenses, and net income or loss. And from here, we can infer some different things. So first, it's important to understand what should be the relationship of gross profit to sales, that which is called the gross profit per percentage or margin. So you want to understand, depending on your brand, depending on the industry that you're operating in, what would be a healthy gross profit percentage. For every dollar that comes in, what should be left after those direct expenses, the labor expense and materials, kind of what is that margin left to take care of your operating expenses? Remember all the other stuff. And ultimately that can go to your bottom line. That is the importance of the gross profit percentage or margin. And it'll range, but you'll notice 50 to 60% is a commonly quoted, like what that should be for a business like this that does have, significant materials and laborers. If you're in a service only type of a business, like consulting, coaching, that the expectation could be even higher there, 75%. But you'll notice right around 50 is a pretty common a benchmark. So I went ahead and figured out, in this case, what are we dealing with? And we're at like 29% in this particular example. So every dollar that comes into the business, there's only 29 cents left to cover rent, management, vehicles, everything else that goes into running the business. And that's a big contributor to why we have a large net loss. I wanted to see what happens if we did hit the 50%. Remember, what would it look like if we had a 50% gross profit margin? That would give us 310K in gross profit instead of the 182 that we're dealing with. And that would actually reduce the net income loss by about 100 grand. So if we had a tighter top line and we have better control over our direct costs going into delivering our service, then we would have a much smaller loss. Now, the fact that we still have a loss means inside of our operating expenses, we must be overspending somewhere. And I can tell you in this particular example, it's the interest expense. There's a total interest expense of 109K. So this particular franchise is pretty highly leveraged, has a lot of debt, and that's why the interest cost is so high. Definitely not going to be the case for everybody. But those two things, if our gross profit were tighter and we weren't as leveraged, this would actually be a profitable year. I hope you learned something from this video. I'm going to make more and more of these. We want to share as much financial information as we can, give as many tools as we can to the franchise, the community, because we want you guys to be incredibly successful. We want you to make a bunch of money and achieve your dreams. And the way that you're going to do that is by understanding what I'm talking about here, understanding the numbers of your business.